Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard, laughing in the background. Right. You ever just get tickled at the wrong time?
He's making a bunch of faces at me trying to get me to laugh. So. Didn't work this time. But
next time.
Well, I want to welcome everyone to the show. Remember, this is our podcast format. You can go to our website. If you know any friends that aren't getting the show, we can email it to them every week. It's also on YouTube, SoundCloud, podcast.com. All the different places, so you can always get. But we also email it to our clients or anybody on our list, our mailing list. And we'd be more than happy to send that to you. Just call us at 972-715-2424. Or you can go to ilovemyretirement.com. You can send us a message that way. Just give us the email address or name and stuff, and we'll put you on.
Or the formats, if you have questions that you'd like for us to answer on the air or privately, we're happy to do that. One of the things we talk about regularly, a lot of our listeners have a majority of their assets in their 401ks and their retirement accounts at work, which we always recommend is a great place to maximize it. If you can do the 24, if you're over 50, you should. If you can do 18,000, if you're under 50, you should. And the company matches, and it's a great place to grow. So a lot of the folks we work with have the majority of their assets there, right, Vic? About sometimes $500,000, $1.5 million. I mean, it grows quick. Every year you add, the company adds. But a lot of them are unsure how to allocate it. Are they allocating it properly? Do they have overlap between the different funds? Are there really fees involved? And there are fees involved. What's the best way to do it? And they really start thinking about this as they get closer to retirement, right? Because now it's important. Do I have enough? What am I going to do with it? I don't want to lose it now. Before it didn't matter as much because you were younger, but now you really want to be careful. Call us with those questions. We do this every week, every month, all year long. It's easy for us to sit down and kind of give you some guidance. There's no charge. We'd certainly love to earn your business when the time is right, when you get ready for retirement. But as far as walking you through a few things, we can teach you some tricks. We'd love to help you with your existing account. Obviously, you don't need to move it. We can help you and give you some guidance there. As Victor said, our number is 972-715-2424. Feel free to call us. We don't bite.
Yeah, too many people now are doing, we had a show about it a week or two ago, too many people doing the target date funds.
Right.
We showed you there's real problems with those target date funds.
Because they're not really target date funds, right?
No, they're too much equities because they have to compete with one another for business. And, some of them were 80% equities, the 2010 funds in the 2008 crash. So you got to be very careful. The average one lost 45% or so. And that you shouldn't be losing 45% when you're retiring in a year and a half. So they're allocated too strongly towards equities towards the back end. At the beginning, like 2040 fund, 30 fund, they're probably okay. But as you get closer to retirement, you really need to take control of that 401k and allocate it like you should, not the way you think a fund manager's got it on autopilot, because they don't.
That's right.
Remember our number, 972-715-2424. Our website is ilovemyretirement.com.
Victor, what's going on in the world this week?
We got Equifax. Equifax is, I think they data breached everything. We went on there.
Again, right?
Yeah, and they said, you got to fill out this whole thing. And they said, you might have been breached. Please sign this protection thing, right?
Yeah.
Tell me how that works, guy.
Well, if you go to Equifax, you think it's a nice service deal, and there's a deal that says, see if your personal information is potentially impacted, and it's got a little link, check personal impact. You click there, you got to put your last 6 numbers of your Social Security and your last name. And after all of that, the magic answer is your personal information may have been breached. Yeah. So they don't tell you for sure whether it has or hasn't. I think it would probably be safe to err on the side of caution. Assume that there's some sort of breach, so you can go a little bit further. And enough, I'm not trying to hammer Equifax, but just trying to make our listeners aware, where you can sign up for a free 1 year's worth of monitoring. And you ever see the commercial about the bank getting robbed and we're getting robbed? Oh, I'm just a monitor. You know, same sort of thing. They'll monitor it for you for free for 1 year. But when you click that infamous thing that we click every time we download and update new software in our computer that says you agree with the terms and conditions, back in there, what none of us read says that you hold Equifax harmless for anything that may occur. So you may
have occurred
or
already.
may have occurred. So you may or may not want to do that. So the question is, and what we wanted to share with you is, what should you do? One of the things is a credit freeze, which I'll go through, and then Victor probably has some good ideas on maybe some insurance that you could probably take out to protect yourself. How to freeze your credit. What you need to do if you want to freeze your credit, and why would you freeze your credit? Because you don't want anyone opening up a credit card on your account, because now they have your information. And the more credit you have and the more money you make, obviously the bigger ding it'll be, because they can get a $20 or $50 or $100,000 credit line and really put a hurting on you. So if you want to freeze your credit, if you're not sure, or if you're curious or suspicious, you've got to contact all three of the major credit reporting agencies and request them to freeze it. Some of them will ask you to do it in writing, but according to the Federal Trade Commission, they have to do this. Each agency will ask you for identifying information, and you must have to pay a small fee. When you freeze your credit, these agencies will give you a PIN number that you can use to unfreeze your account down the line. Once you've frozen your account, it's pretty much as stated. If you need to buy a car, you want a car loan, if you're going to buy a home, you'd have to recontact these agencies, give them this PIN number, and you could say, I want it unfrozen for the week of, for the month of, give them a time frame, and they can unfreeze it, and then you can have your bureaus checked by any loans or mortgage companies or automobiles or anything that you're trying to do, and then immediately it would be locked down and it'd be frozen again. So it is a drastic deal, don't you think, Victor? So you have to really, it's one of those deals, it's probably a good idea, but you don't know if you want the hassle, because it's a lot involved to freeze the credit.
I mean, I'm not positive, but I'm pretty sure those companies like LifeLock, that's what they're doing.
Right.
They're just doing it, and they're making all the 3 calls for you or signing the 3 paperwork for you.
Right.
They'll lock it and unlock it. So that might be an option. I don't know much about it. We don't endorse them or anything like that.
Nope.
But I'm guessing if that's the procedure for locking your credit, that's what they're doing. And they're monitoring it and locking it, and you have to call them to unlock it. But maybe it's worth the, $20 a month or whatever for them to unlock and lock at will whenever you have it necessary.
They usually have different programs. Again, like Victor said, we're not endorsing LifeLock. They certainly seem to be one of the bigger ones and well known, but they usually have different levels. I'll use their pricing just to get you in the ballpark, assuming that everyone is competitive. There's a $10 a month program, which is just basically the standard protection. Then they have a $20, which probably instead of $25,000 guarantees up to $100,000 worth of security. Then they've got a $30 a month program. So there's different levels. And usually most of these companies you'll find will have a 30, 60, 90-day free trial, which if you're not sure and there has been a breach, maybe you do a free trial for 60 or 90 days.
That's just something to think about. We're having a lot of clients call us about, what do you do about cybersecurity? You can only do so much. That's just the way it is. These criminals are coming after you. They're coming after you. This is, the way it is. Obviously, I'm sure Equifax had a pretty robust cyber department to try to prevent this kind of thing, since they have all the information for everyone. But even then, you never know. It's probably Russia and North Korea. Those, they're going crazy.
Collusion. That's right.
All right. Let's talk about a little something. A lot of the heavyweights in the investment world are starting to come out about some impending bear market. Now, this is hard for us to even discuss, because it seems like they've been talking about this kind of stuff for 2 or 3 years, and it keeps going up.
That's because the bear market's going on 9 years now. It's been there forever.
The bull market's been there 9 years.
Bull market, right.
Almost 9 years now. And I got to tell you, there's never been a 9-year in history. I'm just a numbers guy. So if there's never been, Maybe it goes 9, maybe it goes 10, maybe 11, but it's eventually going to do something. It's going to go down, right? But these are some interesting tidbits I'll read from some of these. Here's Thomas Forrester. He's the chief investment officer at Forrester Capital. He was a guy in 2007. He's ran this thing forever. But he reduced his bank holdings. He was so worried about bank holdings, he reduced them down to 5%. As a result, his traditional stock fund was the only U.S. stock fund to make money in 2008. The only singular one. So that's interesting. He's basically say 9 out of the 10 S&P sectors. You got utilities, you've got technology, you've got
energy,
industrial, all those different sectors. 9 out of 10 of them are overvalued. Then you got Jim Rogers. He's a big hedge fund manager. He co-founded the Quantum Fund with George Soros. He was short selling bank stocks to the run up of 2008. He was doing that with like those. What was that one movie?
The Big Short.
The Big Short.
That was a good movie.
Made a fortune, right? He said some stocks in America are turning into a bubble. The bubble is going to come, and then it's going to collapse. You should be very worried, he told Business Insider. How big of a crash should you brace for? It's going to be my biggest in my lifetime, the 74-year-old said. He said the 2008 financial collapse was as bad as it was because of rising leverage and debt throughout the global economy. It's real estate, right? Today's debt levels dwarf 2008, he noted. That means Congress may have less room to cut taxes or borrow to spend to help jumpstart the economy again. In the long run, steep government debt also translates into higher interest rates, making it more difficult for government and businesses to invest in the economy. Mark Faber. I kind of discount a lot of stuff Mark Faber says sometimes because he's a traditional bear guy, which he's right about every 10 years, But he is talking about the historical PE. We talked about this, 2 weeks ago or last week?
Yep.
It's 17. Is historical on, there's different ones. There's forward-looking, back-looking, averaging.
Right.
But that particular one he's looking at is 17. When it's 30 today, its average is 17. Almost all of them are double. He goes, once people start selling, there'll be an avalanche. I think the realistic scenario is asset holders will lose 50% of their assets. Some people will lose everything. It's because they're concentrated. What he's saying is his major concern right now is the breadth of the stock market rally. There's only a small number of stocks. 5 tech stocks have accounted for a huge part of the gain over the last year. He goes, anytime it narrows, that means the bear is coming. There's another one, Bill Gross. He manages, he's been around for it. He goes, don't be mesmerized by the blue skies. All markets are increasingly at risk. Investors have resorted to making money with money. Bill Gross says, with more money funneled in the financial economy than the real economy. What happened in stocks, everybody thinks a company's worth their balance sheet. A company's worth if you have more buyers than sellers.
That's right.
That makes prices go up. More sellers than buyers makes prices go down. Well, think about the billions and billions going into the stock market every month just in 401ks.
Absolutely.
There's nobody selling.
Self-perpetuating to an extent.
It's crazy. He goes, U.S.'s high debt, aging population, automation of labor, big problem in productivity. And productivity is a long-term driver for economic growth. He says the current set of challenges promises to stunt U.S. and global growth far below historical norms. Rob Arnott is the chairman of Research Affiliates. What did he say here? He's not feeling too good about the U.S. stock market. He says investors are devoid of the necessary caution.
That is the line. We were going over this earlier today, and Victor was reading some of the points that he wanted to get to. And when I heard that line, I wanted to take a second and emphasize that with all of our listeners. Investors are devoid of the caution needed. If you're getting close to retirement, we talk about handling your income, peeling off. You've made a lot of money. It's been a huge, long bull market. Take some of that. Take care of the income. Be cautious now. You don't have to get out of the market. We're not saying run for the hills, but I'll let Victor finish. Sorry for interrupting, but be cautious.
It says in the United States, there's not enough fear. There's a sense the risks are not there. But every measure that you can say says it's overvalued. Every measure. And I talk to people all day long. It's what I've done for 30 years. Every single person agrees. Oh, yeah, it's going to crash. It's definitely overvalued. None of them want to do anything about it, though.
No, you can't get
There's not enough of that fear. Think about it. What's happening? North Korea said, well, you better not fire enough another missile. Well, let's fire out 4 of them. How about that? I think they're going to be buddies of ours. Let's fire another one.
Yeah.
All of that, and the market goes up.
Yeah.
You've got a possible trade war with China, which has implications not just in China, but the United States. It could crash the global economy. That's how big it is. Yet the market hears the noise of that, it goes up again. Yeah. But those kind of things, they gave me a few other. There was 5 signals to look out for. We talked about the PE ratio. By the way, the PE ratio is higher now than at any time in 130 years, except for 2 times. But before the Great Depression.
In 08.
And the late 90s.
Okay.
Like 99 before it crashed. Right.
Yeah.
And so a lot of people say, well, the market only lost 40-something% from 2000 to 2002. The S&P did. Most people weren't in the S&P.
How about the
They
How
were
about
in the NASDAQ. The tech stocks lost 80%.
Oh my
Lord! It took 10 years to come back. Now, if you're 30 years old, you got time. If you're 60 or 70 years old, do you have another 10 years just to get your money back if it comes back this time? Which I'm pretty sure it does eventually. I don't know how long it might take because back then, when it came back before, we had 3 or 4% growth. A growth rate of 3. What do we got now? 1. We're lucky to have a 1% growth rate. So a rebound would take longer this time than ever before. So you got to worry about things like that. Yes, crashes after a crash, market rebounds quicker, but it's based on some kind of growth rate. And it's all going on some kind of measure like the PE ratio. Consumer confidence, here's another one, 118.9. A reading above 100 typically signals a bear market. Now, wait a minute. People are confident. Why would that signal a bear market? It's that same thing. Who was it? J.P. Morgan or whatever? Once my shoe shine guy started
giving me stock recommendations. I knew
I got to get out of the thing.
We've talked about it before, and it might be a good thing to go over again, but you have to avoid the herd mentality. And to tie that in, if you look back at the late 90s before we got to the 2000s, everyone wasn't in tech stocks. They were in blue chips and probably doing the right thing and diversified, probably taking care of some of their income. But their friends were making fortunes in tech stocks. How long can you sit on the sidelines, have patience and self-control while your friends are making fortunes? Now, they lost fortunes too, but you get in that herd mentality. Oh, I got to have some of that. Everyone's doing it. It's easy.
I'll never forget it. We talked about it on this show before. I think it was 99. A customer, a friend of mine at a party. How'd you do for your clients last year? I said, I don't know. It depends on the client, maybe 10 to 20%. And he goes, oh, you must not know what you're doing.
Right.
Have you ever heard of a tech stock? Of course, that person not only lost all their money, but they leveraged the brokerage firm, so end up owing $500,000 to the brokerage firm. That's what happens.
I had 2 friends. I'm sure you've had some too. One did, but one was on the cusp. Great 6-figure job, long-term, actually an accountant. They were going to quit their jobs and trade stocks full time. It was intoxicating.
That's what happened because the confidence was so high. Right. Everybody knows they can beat it. I'm telling you, you can throw a dart at the Wall Street Journal in the 90s and pick a winner.
Yep.
And right now, it's similar. And that's the time you need to be thinking about getting out. There's also something called the misery index. I know it's weird, but you take the unemployment rate.
Does that have to do with being married? Just saying.
No. Take the unemployment rate plus the inflation rate. Right now, we got an unemployment rate of 4.3%, inflation rate of 1.9. That's a misery index of 6.2. A low score indicates a market peak. So the lower it is,
right,
the worse it is, right?
So where it is?
Well, in 1999, it was 6.7.
That's low.
6.2 now.
That's low.
And that's before the crash. And before the crash of 88, it was 6.5.
And we're lower than both.
Lower than both. And so there's a lot. The exposure index, the exposure, weekly exposure for they send it to money managers how much equities they have has been coming down, and so you got to be careful there. The put call ratio is weird. Like how many people are buying puts? Put means you think the market's going down. Call means you mean it's going up. So if it was a 1, that means there's just as many people betting on it's going down as going up. If you have like a 0.5, that means half the people are buying puts and half the people are buying calls. So the higher you are, the more bearish it is. So right now we're at a 0.69, which means 70% of people, which is a bearish indicator as well. The lower the number is more bullish. This is more bearish.
And
there's just 1,000 things that are pointing to it.
And we're going through all of this to encourage you to be cautious. We're not telling you to get out of the market. You've got the 401ks, and I know you're contributing, depending on your age and where you are. But you've got to diversify.
But start stripping it down.
Yep.
Right now is a great time, even if you're going to stay in the market. Start paring down, because think about it. Your bonds have made nothing for a couple of years. Stocks have made 10% this year, I think 20 since Trump got elected. So now your allocation's out of whack. Remember, it's a 100 minus your age. The easiest thing is just whatever your age is, that's how much equities you should have, or exposure
max.
to equities.
That's a max
right.
you should have if you're not risk adverse.
Think about it. When you're 30 years old, is it okay to be 70% stocks? Of course it is. 80, 90 if you want, right? But what if you're 80? Should you have 80% stocks or 20? Probably 20. Now, there are exceptions to everything. I know some very aggressive 80-year-olds and very conservative 40-year-olds. But those rules have been there for a long time for a reason. They're to protect you if something happens.
Yeah, and for clarity's sake, whatever age you are, that's the percentage of your portfolio that should be secure and protected.
That's right. And the one thing that a lot of people are doing for their secure piece, they're doing a little bit different. They're saying, all right, I've put a lot in these high-yield bonds. That's my secure piece, when high-yield bonds have as much risk as stocks right now.
I like the way high-yield bond. I don't want a low-yielding bond,
That's right. Everybody wants a high-yield bond.
I want a high-yielding stock.
They're
go
called
with that
junk.
high-yielding bond.
It's funny. It's funny how this industry markets things.
Oh, yeah.
Remember the biatical settlements? They went bad. We can't call them that anymore. Let's call them life settlements.
Let's call them life settlements. That's right.
Well, junk bonds went kaput. We can't call them anymore. We still want to sell these junk bonds. Let's call them high yield bonds.
Oh, I like that. High yield, yes. I don't want a low yield. I want a high yield bond.
It's all the exact same thing. And so what we're saying is it is time. I know the market keeps going up. I watch it every day. I've been managing money in the stock market for 30 years.
We're in the market.
We're in the market. But these kind of things, you're getting to a point where maybe you miss out on the last 10%, but you also miss out on the 50% drop.
That's right. And if you get out now, chances are the market will still go up some. We don't know if it's 5, 10, or 15%. It's going to be hard for you to sit out and watch it go up, but you're not taking everything out. You're just paring it down to where it should be based on your age and your retirement horizon.
And that leaves you, if you do it right and allocate it correctly at all times, it allows you to stay in it when it goes down. Because I'm telling you, if you got 80% of your money in the market and it crashes 50%, you ain't getting back in for a while.
No.
If you got out, right?
Until it's gone back up
That's
enough
right.
and you miss that.
And you never get out at the high. I haven't met a human being in my life that got out at the high. But not only will you not get out at the high, you won't get back in at the low. And so you'll basically lose off the top.
Yep.
Then you'll lose part of the rebound because you want to make sure it's a it's really coming back, not just a false, bottom. There's all kinds of things like that. And those kind of people, market's only made 4.06. The average person makes considerably less than the market because of those kind of things.
And that's if you pay no fees. And keep in mind, again, it's all about your age, your time horizon, and reallocating. And if your allocation is right, it's amazing what just happens for you naturally. And I'll explain briefly. Your 401k, you always hear about dollar cost averaging. You buy stocks when they're going down, so you average your costs low. You buy the stocks as they go up, and you're averaging your costs. That brings your cost up. Your 401k does that for you anyway. Depending whether you get paid weekly or monthly, you're buying as the market goes up and as it goes down. So you're dollar cost averaging your investments. That's a good thing.
Absolutely.
But you don't want to have it all there. You want to diversify it. That's only part of the rule. The rest of the rule, your age, make sure you've got fixed. The older we get, the more we want in fixed. Be cautious.
Let's give you a couple of ideas about what to do now. You don't have to just sell everything and put it in a CD. But like our managed program is one thing. You remember we manage money at Fidelity. Basically, we're in every sector of the U.S. market. If any sector goes below its moving average, which each one has its own based on the volatility, it's automatically out of that sector.
And you just mentioned, 10 minutes ago that the market's narrowing now.
That's right.
How many sectors are positive now?
They're all positive right now.
But there was one that wasn't there?
Yeah, no, what happened is 5 tech stocks are leading the entire S&P.
Got it, by a bunch.
Right. So the technology industry is leading everything. But think about it. It's going up. So if it continues to go up, you're still in it. But it's specifically designed to pull you out automatically. It's not an emotional decision. Pull you out when it starts going down. So it protects you, but leaves you in. So you're not missing out, but you are protected to some degree.
And as much as we like this program and it makes sense and it does well, you still don't put all your money there.
That's right. Then you've got another option. You've got some things like we're trying to show you that you can still get the rest of the market return but protect yourself. You have index annuities that give you up years of indexes, no down years. So if it keeps going up, you'll get the return or a piece of the return. But if it goes down, you don't have to take any losses.
That's right.
So it kind of protects you but allows you not to miss out. It's weird how psychologically, how powerful not missing out is. People will do anything not to miss out, or they will never do the right. In their brain and there's everything they do says, yeah, this is overvalued. I agree with 100%. But I can't do it because I'm doing so well right now.
Yep.
Even though you know it's the right time. You think down in your heart, you know it's the right time. That's why these couple of solutions, a managed account specifically designed to pull you out, but leaves you in, it's liquid, no penalties, no nothing, just pay as you go. That's a decent option to help you over the psychological effects of missing out. You don't miss out, and it protects you. Same thing with the index annuities. They're going to protect. They're locking in right now. You'll lock in all the profits. If the indexes continue to go up, you'll continue to make profits. But the day they go down, you cannot take a loss. It'll lock in the gains. Let's say you've got $1 million and it makes 10% before it goes down again. You got $1,100,000. And then it crashes. You can't lose $1,000,001. So it locks in all gains. Plus, it resets your basis. Think about it. If you had a stock at $100 a share, it went down to 25. Well, you're down 75%, right?
Oh, yeah.
If you had something like this, you couldn't take it down here, but you own the shares at 25 now. So they go to 50, you could potentially double your money. When the stock market, you have to go back to 100 per share to break even.
And if I can, I'm going to expand on that a little bit. You know, if you stay in the market all the way and you think you can get out in time, that never works because it usually takes a dive, but it's a double negative. And all we're asking and all we're trying to do for our listeners and certainly for our clients is to have you exercise caution and allocate properly. If you're in that market and now all of a sudden it's turned, you're down 30, we'll use 30%. I won't say 40 or 50. You're down 30%. Well, what happens now? Are you going to get out? No, you're down. You know, your $1 million
Can't get out now.
No, it's now 700,000, and you're going to stay in it until it comes back. Forget the fact that you could have reallocated maybe and gotten out and adjusted that loss of 30% to a smaller loss, but the time that you stay in that stock just to get back to where you were, had you taken the money out and done something else with it, you would have gotten probably a much better return than having to sit through coming back. But once you're down, you're for sure not going to get out then.
Most people, like I said, planning their vacation.
Yep.
1 year that they go on every year, they spend more time in that one time they spend on their finances, something they might have to live on for 30 years, all of it. But
it's not enjoyable for people, I don't think.
And that's why that
Is there something wrong with us?
Yeah. It's analysis paralysis is what they call it. Because remember, if you're in stocks, which I love stocks, we love stocks, we manage money in stocks, right? If it's going up, well, I'm not going to sell anything that's going up. That's crazy. What am I going to put in that money market? Bank's robbing me right there. That's
right.
Dumb.
0.1%.
I'm going to stay in this.
That's right.
All right. Or if it goes down, well, I'm not going to sell it. Now I'll realize the loss. Trust me, you've already realized the loss.
It's going to come back. I'm staying in.
Yep. I'm just staying. So you can't sell when it's going up. You can't get out when it's going down.
Well, great for stock, guys.
It's fantastic. But that's the kind of mentality you have to pull yourself away from. You can't be emotional with your money. It can't be a gut reaction or knee jerk, even though like I said, I've got one of my best friends in the world, goes to the casino, puts his hand over a slot machine.
Do I know this
person? He says, you do. This is the winner.
I know who it is.
He goes by his gut. I know that sounds crazy, but...
Does it work?
Yeah. No.
Okay. I'm just checking.
They all think it would. What you do is you compartmentalize losses. That's what people do.
Yeah.
They'll say, no, I always win that. They never end up with any money at the end, but, well, I spent that on this other thing.
I won $10,000.
Oh, yeah. They don't have Picassos in Vegas because everybody's winning. I want to thank everyone for listening to the Common Sense Investing Show. Remember, if you have any financial questions, you'd like to take advantage of our no-cost, no-obligation retirement plan, stress test, Social Security Optimizer, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. 2424, and you can always go to our website, ilovemyretirement.com. I'm Victor McClure. For Guy Allard, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.